Welcome back to the channel. My name is Mac Rogers. I'm a real estate broker here in the East Bay of the San Francisco Bay Area. In my last video, I talked about the latest pending home sales report from the National Association of Realtors. I will put a link to that video here. Basically, the headline was pending home sales sagged 1.2% in March. Key highlights of that report is as follows. Pending sales fell for the fifth consecutive month, down 1.2 in March from February. Pending sales rose in the Northeast and fell in the other three regions. Compared to the prior year, pending sales fell for the 10th consecutive month by 8.2%, with pending sales down across all regions. Today, what I want to bring to you is the latest report from the Mortgage Bankers Association. The Mortgage Bankers Association conducts weekly survey of its members to see what is happening in the market. And according to the latest survey, mortgage applications decreased in the latest MBA weekly survey. This is what they said. Mortgage applications decreased 8.3% from 1 week earlier, according to the data from the Mortgage Bankers Association's weekly mortgage application survey for the week ending April 22nd, 2022. Why is this important? Well, coupled with the pending home sales report plus this MBA report, we can see or have a clear picture of what might be transpiring in the future. We can look at mortgage application as a leading indicator of future home buyers. Obviously, the less people applying for mortgage, i.e. mortgage applications, that means there are less would-be home buyers as well. The article goes on to say the Market Composite Index, a measure of mortgage loan application volume, decreased 8.3% on a seasonally adjusted basis from 1 week earlier. On an unadjusted basis, the index decreased 7% compared with the previous week. Then it talks about refinance index also being down, which we won't discuss it here. So it continues. The seasonally adjusted purchase index decreased 8% from 1 week earlier to an unadjusted purchase index decrease 7% compared with the previous week, and was 17% lower than the same week 1 year ago. So 17% when compared to a year ago, plus also a decrease from the previous week, is to me a sign, or at least a start of a sign of what's to come. And that could mean less buyers out there. Let's look at the rest of the report. With mortgage rates increasing last week to the highest level since 2009, applications continued to decline. Overall, application activity fell to the lowest level since 2018, with both purchase and refinance application posting decline. Again, after that, it talks about refinance. We'll jump to the next line, which could be concerning. This is in regards to the economic and industry forecasting. It says the drop in purchase applications was evident across all loan types. Prospective home buyers have pulled back this spring as they continue to face limited options of homes for sale, along with higher costs from increasing mortgage rates and prices. The recent decrease in purchase applications is an indication of potential weakness in home sales in the coming months. I could not agree more with this paragraph. You see, mortgage applications is a sign of how many would-be prospective home buyers are out there. Simply put, the more mortgage applications there are, or people applying for mortgages, that means that's the number of prospective home buyers. And the opposite is true. Less application means less buyers. And furthermore, what is concerning about this is that we are actually headed into the spring and summer selling season, which traditionally have been the busiest time in real estate. And what they are saying basically is this might be a slow selling season. Now, here's another part that could be an issue. Joel Kahn, the vice president of MBA, said, in a period of high home price growth and rapidly increasing mortgage rates, borrowers continued to mitigate higher monthly payments by applying for ARM loans. The ARM share of applications last week was over 9% by loan count and 17% based on dollar volume. At 9%, the ARM share was double what it was 3 months ago, which also coincides with the 1.5 percentage point increase in the 30-year fixed rate. ARM stands for Adjustable Rate Mortgage. Now, this is a double-edged sword. Adjustable rate mortgage are great products and great alternative for savvy investors. Basically, the reason home buyers get ARM loans is because the rates are lower than your average 30-year fixed mortgage. Right now, the 30-year mortgage is at 5.2% according to NerdWallet. Their 5-year ARM, 3.48%. So what could go wrong, right? Well, let's say that fast forward 5 years from now and home values went down, you might not be able to refinance if your home's loan to value is less than 80%. So that would be a big problem. Now, say values didn't go down, but interest rates, instead of 5% where they are now, is at 10%. Again, another problem because you would be refinancing at a much higher rate. What potentially you would like to happen are home values appreciating and mortgage rates decreasing. That would be a great scenario. Then you can refi into a fixed rate mortgage. If the first two scenarios were to happen, your options become limited. And that is why I say this is a double-edged sword. You pay low interest upfront, but taking on the risk in the future. The article continues to talk about where mortgage rates are last week and compares it to previous week. Basically, all you need to know about this is that it's going up. And like I said on my last video, if you bought a house last year at this same time, you are paying 31% less than the people buying today. That's a huge jump. Last thing that I want to point out is that they said FHA, VA, and USDA loan applications are up. It's up marginally, but nonetheless, it's up, which is kind of good because if you do get a slowdown, maybe buyers with these types of loans will start to have a fighting chance when it comes to buying a home. So what does this mean for all you buyers and sellers out there? Let's start with home buyers. Basically, this means that there is less competition out there, which could lead to less multiple bidding wars. Now, I gotta say this, here in my market, the East Bay, that ain't happening yet. We just put a bid on a house the other day and there were 14 other offers, several cash buyers. The other thing about this less buyers out there is that you might be able to have contingencies again on your contract. I haven't written a contract or a purchase contract with any contingencies in the past 2 years, and this includes buyers with financing. And buyers, keep this in mind. There is less competition, but there is still competition. Our issue is supply. So even with less buyers, we still don't have enough supply of housing. For sellers, be vigilant about your local market because this could turn on a dime. Keep an eye out on how many homes get listed in your neighborhood and how long it stays on the market. If you start to see a trickle of inventory here and there, then you might start to see the number of days to market those properties go longer or higher. And when these two things happen, sellers become a little bit antsy, and next thing you know, you start to see price cuts. And when buyers see price cuts, they start to have a wait and see attitude. So that's the latest from the Mortgage Bankers Association. With the pending home sales data going down and mortgage applications also going down, this could be the writing on the wall of what might happen in the near future. Hey, thanks for watching. Have a nice day.